Thank you for everyone for attending. My name is Ryan Gardner. I am part of the client portfolio management team. Our mission here is to partner with elite financial advisors. So Frank and the team at CNA Financial Group, we really want to provide you with industry leading service and asset management excellence. The purpose of these webinars is to delve into capital markets, our outlook. We ultimately want our clients and investors to stay on track to achieve your long-term investment goals. We remain committed to communicate our investment strategy and our updates on capital markets. There is a lot of noise out there, and hopefully this webinar will provide more of that signal in terms of capital markets. We have these 5 gauges on capital markets. If this is the first time you are seeing the gauges, we also provide literature on our website. But in terms of the positioning, this is a neutral standpoint in the middle, focusing first on the economic gauge. And anytime you see a gauge moving towards the right, that would be a tailwind, so positive for stocks in general. And anytime you see a gauge moving towards the left, that would be a headwind of neutral. The purpose of this webinar is to go to the detail and analysis in terms of each gauge. This helps form part of our view, particularly around asset allocation. Some of you might be aware of the Total Wealth Strategies, or TWS. So Glenn Dorsey, who heads up our client portfolio management team, sits part of that asset allocation committee, and these gauges help form part of that decision-making process overall. In terms of a summary, one of the aspects I do want to highlight up front in terms of where we are for our price target for the S&P. We started the year. This is what we published in January. We stated that our price target was 700 for the S&P 500, driven by earnings growth. We are in the midst of a very strong and healthy earnings season. It's going pretty well. This is really the underpin of what we've seen, a recovery for stocks in general. There's always a risk to our outlook. There's no shortage. Just think what's happening in the Middle East, the war with Iran. Think other risks, labor market weakness, valuation landscape, government fiscal position, what's happening with the capital expenditure and the AI boom. There's always a risk to an outlook, but in terms of the earnings growth, which I will revisit, that is driving very much the price target for the S&P 500. Our base case remains for the US economy to avoid recession, and we see round about a 3% real GDP growth. This is adjusted for inflation, so you actually have to add inflation back to get the nominal experience in terms of the economy. So still a pretty robust economic picture overall. But reflecting on performance for 2025, and this is a snapshot for Q1, really encouraging seeing that broadening out, so those investors who have well-diversified portfolios. Very encouraging seeing that broadening out. Look at the equal weight S&P showing that resilience, particularly during Q1. Dividend-paying stocks, if you look at sort of the value part of the market, really held up pretty well. Even the volatility that we experienced during March 2026, holding up fairly well during that period. And then look at the other diversification, international, also on a relative basis doing well, and that's building upon that strong progress that international had during 2025. But this was off the back of many years of underperformance, so commending those clients and investors that did continue to hold international in their portfolios. This performance on screen does exclude April 2026, which was very impressive recovery. The S&P alone was up over 10% in the month of April, which was the strongest monthly performance going back since November 2020. Some of you might recall that was when we had the vaccine news coming out of the pandemic, and this also was expressed internationally. International stocks did well, and emerging markets did almost 15% during April alone. Fixed income, pretty positive. 2025, the tailwinds of the Federal Reserve lowering interest rates. Not only are you getting that coupon and that interest, there were potential for capital growth over and above that interest. And then we did have this delay around the potential rate cuts. I will go into monetary policy for why we've seen slightly muted returns thus far for fixed income in 2026. But we do have to overcome a constant wall of worry. I know for our clients and investors thinking about Liberation Day in April 2025, that period of volatility. So that's the first circle highlighted on screen. And then the war with Iran and the conflict in the Middle East in general. This was particularly think about the March sort of low levels that we've reached, and we've had a recovery since then. So this is just giving insight into what we often call this wall of worry we have to overcome. But corrections are normal. This is showing data since 1928 for the S&P 500 and the frequency of declines. And on an average year, we should expect a 5% pullback 3 times and a 10% correction once a year on averages. Some years are more, some are less. These are just averages showing what we should typically expect. So thinking of 2026, a new Fed chair typically does add turbulence. This is very normal. We've had this time and time again. When we have a new Fed chair, the market does like to test a new Fed chair. The other event to be mindful of, midterms, also out of the 4-year election cycle, typically adds turbulence in Q2 and Q3. And as we get to the fourth quarter, that's where we normally see this relief rally. So also year of midterms are things to think about. And that is before we get unknown unknowns, things like a pandemic or the great financial crisis, which can also add corrections. But what should be the focus, and this is what we say to Clark Capital, is that earnings profile. The most important driver of returns are their profits. And we'll revisit this relationship overall. And this is a big reason we've seen the resilience despite some of the short-term turbulence. So focusing on the first gauge, on the economy, these gauges we do update on a monthly basis. So at the end of February, we did have the economic gauge in a half forward position, so quite material tailwinds. And then at the end of March, we did downgrade that 1 notch in terms of so it is a slow forward position. So still tailwinds, and we've kept that in position for the month of April. So what are some of the tailwinds specifically around the US economy? We have all the expenditure from artificial intelligence, and the consumer continues to be pretty strong. And we'll delve into what is driving that consumer spending overall, and then the health of the labor market. So people are still employed, which is driving a lot of the spending. So the Atlanta Federal Reserve, we're thinking around about 1.3%. The official number came in at 2%. They are now seeing over 3% GDP growth for the second quarter. Now, we only in the second quarter as we speak, there's a lot more data to come, but just showing you this continuation around the strength of the economy overall. So still pretty impressive numbers. But what is causing people to be grumpy and just annoyed? On screen here is the brown line is consumer sentiment. So this is a subjective survey by the University of Michigan, and it details how people are feeling. These numbers actually plummeted to record lows, both for the month of March and for the month of April. Dip context for the month of April. The preliminary reading went to 47.6 and the final reading was 49.8. And if you look back to 2022, in fact, was lower than those levels, considering how high inflation was then, as well as gasoline prices. But pretty much people are saying on average, they are feeling quite pessimistic and depressed about the prospects and health of the economy overall. So what is a big catalyst for this? We've included this data on screen, and you can see it even dating back to since 2022, this huge increase in gas prices, same as this huge gap that we've seen in recent weeks as well. It's very visible. We know when we're paying for high gas prices overall, it does make people feel quite grumpy overall. It takes away some of that discretionary income. But what is helping offset some of the high gasoline prices? So one thing is that is quite visible and a good tailwind are the average tax refunds. But the nuance here is these are people who pay taxes. You hear about the K-shaped economy in terms of high income households continue to be very resilient, whereas low income households are showing signs of strain. But high income households, the top 10% of consumers in the US, account for half of the spending. And the average refund is around about 3,500. So you can see tracking well above 2025. So let's look at some of the data. Where are people spending money on? The Federal Reserve look at things like retail sales, personal consumption expenditure. So that's very economic speak. So what are some of the things as us as individuals can look at? We used to look at this type of data coming out of the pandemic, also known as high frequency data. Restaurant bookings was another one, but looking specifically at air travel. This is showing the number of people through TSA checkpoints, and you can see even towards the end of March, so a month, pretty much a month into the war, still tracking at record levels, well above previous years in terms of the travel that's going through. As with all data, one can get very analytical. This excludes private travel. A lot of private jets clearly do not travel through traditional commercial TSA checkpoints, and we know the spend on private is clearly well above commercial travel. But just giving the insight that in terms of the average consumer, as well as business travel, remains quite robust despite elevated airfares and showing the ability to withstand this energy shock and elevated, energy levels that are leading to slightly higher airfares overall. Looking at debit and credit card transactions, we're not seeing any sort of slowdown or collapse in consumption. This was confirmed as well with retail sales. The common question we get from some people is that this was all driven by gasoline sales. Even if you exclude gasoline, there's something called control group. So that excludes autos, gasoline, building materials, and food services. Even for the month of March, that was up 0.7%. And restaurants during the month of March was even up 0.1. So on average, just showing people are still spending pretty healthily. And when we looked at earnings from the likes of American Express, Visa, and MasterCard, supporting a lot of what we can see here, this high frequency data. So what is supporting this economic resilience is the labor market. But we are in this realm of a pretty low hiring environment, but the layoffs remain pretty muted. So the low fire as well. So I want to focus on this light blue line at the bottom here. Questions we've been getting. What are some of these impacts from artificial intelligence? Are we seeing a spike in layoffs? And even though we're seeing announcements, particularly from the technology side of the economy, this is not actually translating into the broader, call it the unemployment rate. We've got unemployment numbers recently, and it's still hovering at that 4.3% number. So still quite low levels of the unemployment rate. And then every Thursday, we get something called initial jobless claims. So people who make their first application for unemployment insurance benefits. And 2 weeks ago, we got the lowest reading since 1969 of 189,000 people applying. And this has been if you look at the 3 month average, is now below the 6 month average. So just seeing this continued downward trend. And then individuals who are on an ongoing basis, who are applying for continuing claims for unemployment insurance benefits. That hit a 2-year low last week of 1.7 million. So just again, seeing this continued trend, not seeing a major uptick in layoffs, but we do need to acknowledge the slowdown as well in the number of hires in this dark blue line at the top here. So showing that we are seeing that slowdown there, which is why the Fed do spend attention and focus on the health of the labor market overall. Questions we do often get are comparing this current energy crisis versus the 70s and the 80s, showing that the average person spends significantly less today than what the energy shock was, particularly in terms of the 80s. In the 80s, around about 10% was spent on energy. If you looking at electricity, nat gas, as well as gasoline, versus where we are today is below 6%. But acknowledging that even though it's a lower burden today, you still have these shocks overall. So the average person, according to the Bureau of Labor Statistics, this data was quantified in December of 2025, and it was focusing on calendar year 2024, spends about 17% on transportation. Of that 17%, only 3 is on gasoline. So let's say um, you know, almost 80% is non-gasoline related. So think insurance, the actual expenses to maintain the vehicle, people spend on public transit, so specifically non-gasoline related costs to transportation overall. And about 2,400 specifically is what the BLS state the average person spends on gasoline. So if the average refund that I mentioned earlier is about 3,500 in terms of IRS tax refunds, you can see how we are seeing positive offsets against some of this energy burden we're going through. But in terms of the K-shaped economy, low-income households do spend a larger proportion on transportation, housing, think food, as well as clothing and apparel in general than what these percentages. So they will have less discretionary income in terms of what I say high-income households would have. So we'll acknowledge certain households will be disproportionately affected based on this. So the reason we spend significant detail on the economy is that in the long term, the economy drives corporate profits, and corporate profits, which on screen here is the brown line, drives the S&P 500, which is prices. This is the relationship dating back since the early 50s, and you can see how well intact. The more profitable the business is, the more investors are willing to invest and pay for that stock. The same principle applies for private businesses as well as businesses listed on the NASDAQ or say New York Stock Exchange. And just showing those profits is a big reason we've seen that continued resilience overall. So focusing on the market expectations for 2027, this is important in terms of what the market is thinking about going forward. This number has continued. We're now above 380. And this is important in terms of particularly what happened during the war and Q1 of 2026 is unlike other crisis events where profit estimates were lowered. If you think about 2026 earnings, when we went through all the tariff uncertainty and anxiety, profit estimates were lowered. And as we had increased certainty and less uncertainty, you could see those profit estimates were increased for 2026. But for 2027, the expectation has been an increase. And as we've had more and more corporations report for Q1, this has solidified those strong fundamentals overall and really given validation around just how strong these profits are. The balance here is not all stocks are doing well. There's still headwinds facing certain businesses. I think tariffs will impact more businesses than others. High energy prices most certainly will impact more businesses more than others. And then AI. AI is disrupting some of the software names. They're potentially going to be disrupted. So our focus at Clark Capital as an active manager and individual security selection will hopefully to avoid some of the losers within the S&P and allocate more towards the winners that are benefiting from some of these positive tailwinds. But did want to spend time on these earnings. The question we often get is how can the S&P and stocks in general, be close towards these record levels, even when oil prices are above or near that $100 level overall. And this is based on pretty robust earnings that is driving a lot of this growth that we are seeing. Focusing on the second gauge on monetary policy, we did dial this gauge one notch back, so still a slow forward position. We do expect some tailwinds from the Federal Reserve in terms of their policy for interest rates. What is leading to some of that delay in terms of rate cut expectations? It is based on what's happening with oil and the expectation for inflation. We are entering a new chapter with the new Fed chair. We've only had 5 Fed chairs since 1979. So in terms of thinking about the importance of a new Fed chair, potentially will be Kevin Warsh. We have to go through the Senate confirmation process in terms of the official voting. in terms of that being actually confirmed. But what does the market believe in terms of the interest rate projections going forward? This was a snapshot in April, and you can see there that the market was having a pretty low probability of a 2026 rate cut, maybe towards the end of the year in December. You can see the probabilities, towards one, but pretty much looking towards October 2027 for that next rate cut. But the big sigh of relief is certainly towards a rate hike is a very low probability at this point. And that's a big reason we still have this gauge in a slow forward position. Is unlike the 70s and 80s where Paul Volcker had to increase interest rates, that is still a low probability at this point. And the Fed themselves have acknowledged that they still are thinking about easing rates. We just have to be a little more patient. But patience is often well rewarded. This is great research that we get in the industry. This is from Ned Davis, a phenomenal independent research house. And the blue line on screen here is showing a slow cycle where the Fed do less than five interest rate cuts over a 12-month period. And you can see how that is the best environment for stocks to perform. Typically indicative of a healthier economy where the Fed don't have to dramatically lower interest rates because the economy is in a good position. They can be very gradual in terms of those rate reductions. And the orange line is where we are currently. So almost happening with the historical playbook with that light blue line. So pretty encouraging seeing that we are on track for a gradual easing cycle and being patient for the Fed. The third gauge on valuations, we did actually have this gauge in a slow reverse position in late 2025, and we did upgrade that to a neutral position. The reason for that is some of the growth stocks were getting a little elevated versus the historical averages, and that was the reason we did have it as a headwind. We'll go through some of the detail. There is a style difference if you look at growth versus value, mid and small caps, as well as US versus international, in terms of why we still believe valuations in general are still, broadly speaking, in a neutral position. So looking at some of that divergence, if you look at the S&P in the blue line, you can see in 2025 over here, just getting a little elevated versus its history here. This is just since 2012 overall. The sort of way to think about valuations overall is that even if they are elevated, they're not a useful timing tool. Valuations can be elevated for an extended period of time. You can see the Magnificent Seven. The name and the list of those stocks are detailed at the bottom of the screen here. Many years ago, we called them FANG. Some called them the Elite Eight, if you include Netflix in that list. So there's different classifications, but these hyper growth cash flow generative businesses have commanded a premium versus the broader market, and they've also been growing at elevated levels of profits, and hence that premium status from a valuation point. So if one had only used valuations, you may have missed out on some good returns from some of these stocks. You still need to do that analysis and due diligence at the individual stock level. There are clearly very different businesses within even that list of seven. But in terms of that valuation, you can see in late 2025 why we did have that valuation gauge as a headwind. But in terms of what happened thus far in 2026, prices came down a little during the month of March, but the earnings growth is a big reason we've seen these valuations come down lower. And valuations are a very important philosophy and cornerstone principle in our overall classification in terms of allocating within our stocks. So linked with valuations, we do get the question on, are we in a bubble? Where are we in valuations? So sticking with the Magnificent Seven allocation, you can see on screen, we've got the red line showing the valuations. If we strip those out, trending towards about 23, same sort of time frame since 2013. You can see how the valuations have started moderating, going lower. But if you include that earnings growth, still double-digit, exceeding 20%, and that has been a big reason these stocks have maintained their premium status overall And this is where it's very important to have individual security selection. There is a dispersion between valuations in these names, and you need to make sure that you have that active manager doing that additional analysis to ensure that you do have the appropriate portfolio for your risk profile overall. So, in our opinion, we are not in a bubble territory. If you look at these stocks, at a PE of low 20s, this is not extreme valuations, but are there stocks trading at much higher multiples? Absolutely. You can see PE ratios of 100, 200, 300. This has happened many times in capital markets. It's not unusual to see areas of excess. And our role at Clark Capital is to avoid some of those very extreme valuations, which is why we have a very disciplined investment philosophy. So, what are some of the other areas of balance within capital markets? And we're not seeing areas of excess. Mid and small cap stocks, they trade at much lower valuations, around about 15, 16 overall. You can see outside the S&P 500 in the blue and green. So unlike the large cap names in the S&P in the red, much lower levels of valuation. What has been very pleasing in recent months is we are seeing an acceleration in earnings growth. Unlike coming out of the pandemic, mid and small cap stocks had pretty limited earnings growth. So that was a big reason they traded at lower valuations. Unlike the red line here showing the large cap growth, that's where a lot of that profit growth was coming from, were the large cap growth names. But in recent months, we've actually seen this acceleration. If you look in the blue and the green line, which has really supported some of the outperformance we're seeing in the mid and small cap stocks overall. And the same thesis applies to international stocks. In our view, they should be trading at lower valuations versus the US, but it had just got so extreme. If you think about particularly heading into 2025 versus the actual US stocks overall, just really extreme levels, almost like a coiled spring. At some point, you would expect it to snap back between the two, and we did see those valuations really diverge and move back towards a more neutral standpoint. So it does validate, in our view, the reason to have that international exposure within your portfolio. Areas like dollar weakness, you're getting that earnings growth really does support a year like 2025 and 2026 when you consider this in combination with that valuation overall. Onto the fourth gauge with investor sentiment. This is the most sensitive gauge. It can move pretty materially. A lot of the data we look at for this is based on a contrarian lens. So do the opposite to how the data does actually come out initially. If we had to look at this gauge in real time, we most likely would be dialing this back. This was set at the end of March, so a live sort of view on this would most likely be towards a neutral to possibly even a slow reverse position, just to give you an insight into how sensitive this gauge can be. But at the end of March, we had upgraded this into a half forward position. The big reason for that, if you think about Warren Buffett and that great mindset about being fearful when others are greedy and being greedy when others are fearful. And one of the surveys we look at is from the American Association of Individual Investors. And what happened particularly during the month of March, you can see how in the red areas that's defined as being bearish or known as being pessimistic, the question that is posed in the survey is where do these individuals think stocks will be over the next 6 months? So that pessimism started to creep back in, unlike what it was at the late 2025 heading into January of this year, where that pessimism was pretty muted and quite high levels of optimism overall. So I mentioned how you want to do the opposite, so be contrarian. So that's a big reason why we did upgrade this gauge into the half forward position, because we were anticipating tailwinds from these pretty high levels of pessimism overall. We also look at the institutional world in the famous fear gauge, so the VIX index, the VIX. What's been useful when looking at this is when the VIX and the brown lines does go pretty high, and when that spikes, you can think about Liberation Day when we got to reading above 50. That normally signals pretty high levels of fear. that normally helps to identify getting towards the bottoming of the S&P 500. It's not a perfect science, but you can see when we've looked at it on history, when you get those big spikes, just like we did get not a very large spike, but it did spike during March 2026 when it got to above 30. That also, when we think about the long-term average, is a level of 20. Just to draw a line here since early 2025. So anything above that long-term average is where you can think about being elevated levels of volatility. So what keeps some of these short-term corrections and pullbacks at bay is a huge amount of liquidity on the sidelines. This is where I know the expertise of Frank and the team at CNA Financial Group have great expertise on one's individual goals and investment objectives and risk tolerance. But this is purely showing money market funds in the United States that exceeded 8 trillion in value. This excludes CDs and other types of savings vehicles. But just these types of savers were looking for an entry point either into the bond market or into stocks. So when they've seen these periods of sell-off, they've been looking for this entry point and this huge level of liquidity and cash on the sidelines, certainly waiting for that opportunity when we've seen these bouts of volatility. On the fifth and final gauge of interest rates, we've also kept this in the slow forward position. Why it's good when interest rates typically are declining, that is normally a good tailwind for stocks overall. Focusing on the yield curve, what we have on the vertical axes are the interest rates on treasuries, and the horizontal over here is showing the actual term, all the way from overnight up until 30-year maturities. So very little change in interest rates from the beginning of the year towards April, but a slight shift up. You can think about it in the sort of intermediate from the 2-year to 5-year, and that's just simply being a little more patient on some of those rate cuts is why we've had that little shift up. Potential inflation coming in as well, which is leading to that. But the big shift we have to acknowledge has been on the short end of the yield curve. So let's call it overnight up until 6 months. That full 1.75% decrease in interest rates by the Fed has led to that what we call reinvestment risk. As these maturities come up for that reinvestment, they're locking in lower and lower interest rates as they come up for maturity. And that we've seen that big shift in the short end of the yield curve. And we've seen an increase in the longer end of that yield curve overall. But the most pleasing aspect is at least the blue line is an upward sloping yield curve. That is more normal. The brown line is a downward sloping yield curve. So a very unusual interest rate environment in terms of what we can think about in late or September 2024 overall. Final topic on special topics as we continue with geopolitical risk. This is just I'm sure many of you have seen this type of data before. This is a slight twist. This is a log scale. This is simply percentage adjusted for the S&P. The reason being, 50 points today, movement in the S&P, most people would not notice, but 50 points in the 30s and 40s was clearly a huge shift in the S&P 500. So a great way of showing it is as percentage adjusted when we look at this type of format. You can see the history on this time frame and just showing the resilience not only of the economy but the ability of the S&P to overcome a lot of those bouts of volatility. The consumer continues to spend during these time frames, and we see the corporate profits overall. And we remain committed to continue to communicate our latest investment strategy, and really want to thank everyone for attending, and we'll continue to provide our insight on capital markets. Thank you.